With the world's attention being focused on Nvidia, could this be the chance for stocks like AMD to be slowly and quietly catching up? Or could we even see stocks like Supermicro suddenly explode again? In this video, we are going to be going over exactly this. We're going to be looking at my mechanical market strategy. We're going to be looking at intrinsic valuations, discounted free cash flow analysis. We're going to be seeing whether or not these stocks currently look overvalued, undervalued. We're also going to be looking at a breakout score for these stocks to see whether or not it could be a good time to be buying into a position for these stocks currently. And we are also going to be assessing their status within the macroeconomic world currently. So let's quickly start this video off with Nvidia. They are the undisputed king of GPUs and now the godfather of AI infrastructure. Their chips power everything from ChatGPT all the way down to gaming rigs. They dominate the data center AI chip market with their H100 and upcoming Blackwell architecture. So basically, if something states AI, you best believe Nvidia probably has something to do with it. With Nvidia's current revenue coming in through 4 key segments at the moment, one of these being data centers, in which is their main cash cow currently. And then of course there is the gaming segment for Nvidia, which used to be number 1 but is now only at number 2, and this is a industry that is in decline now. Nvidia are also in the automotive industry. This is a slow growing industry. It's still very small and it's not really got its footing yet, but there is room for this to explode massively in the next 10 years. And then there is of course the Omniverse and AI enterprise, in which they are betting on massively for the future. With everyone from Meta all the way to Microsoft bulk ordering their chips like it's Black Friday at a Best Buy, their gross margins are insanely high at over 75%, which we will get into later on, because they own both the hardware and the CUDA software ecosystem. But of course, currently in this economic climate, there is always going to be a risk to stocks like Nvidia. With the US government keeping tight restrictions on advanced chips going to China, Nvidia can't sell their top tier GPUs, the H100, A100 and Blackwell, to Chinese firms anymore, which will of course in turn hurt their business. In response to this, Nvidia have made China-only downgraded chips like the A800 or the H800, weaker versions designed to comply with the US trade rules. But now even those are being restricted, so it's moving the target for Nvidia. So of course this stock doesn't come without risks, and one of these being China was a 20 to 25% of Nvidia's data center revenue in 2023 to 2024. Losing access to this market is of course going to be painful for Nvidia, and then there is of course the risk of retaliation if China hits back. For example, limiting rare earth or banning US chips in Chinese servers, Nvidia could get hit too, in which China are to an extent already doing with the rare earth materials. So how will this play out? Well, Nvidia has got enough global demand in Europe, the United States, India and the Middle East to weather the current China storm, but long term, if China develops customized domestic GPUs, this will obviously hurt Nvidia's dominance. For example, companies in which are in the Chinese hemisphere are looking at this, such as Huawei or Birian, probably mispronounce them knowing me, but they are of course key competitors on the Asian side of the world. So Nvidia is of course being hurt quite badly now, with China being the slow burning fuse under their feet, potentially causing this stock to explode, and not in the good way. They do need to somehow pivot towards a more Western market, which of course they already do, but they need to essentially assert dominance within these regions. But in this video, of course, we're going to be looking at some other competitors in which might potentially take this market away from Nvidia. So on a technical analysis for Nvidia, this company looks absolutely outstanding. Looking here on a retention basis, we can see that a mean comes in at 55% over the last 5 quarters. And their liquidity ratio also looks absolutely amazing, with them coming in at 3.32. That means for every dollar of debt in which this company owes, they have $3.32 of liquid cash to pay this back in, which is obviously massive, as in the world of business, cash is king. And again, on a free cash flow basis, this company looks absolutely amazing as well, with it increasing quarter over quarter, and on the trailing 12 months here, they are projected to be at $60 billion. Furthermore, on a exponential 365-day chart, we are now below the trend lines, which could indicate that there's going to be a lot more selling pressures, but it could also indicate that we might match up with this trend line within the next coming months. But of course, that is very dependent on what happens geopolitically. Looking here on a normalized distribution, we can see that the probability of a positive day for Nvidia is 52%, and the probability of a negative day is only at 37%. So the positive outweighs the negative here. Looking on a 91-day chart here, we can see that we are actually on this exponential moving average, which indicates that we are actually in a sustainable position. And I'm sure what a lot of you are actually here for now is the intrinsic valuation. This looks absolutely incredible for Nvidia as well. I have a bullish intrinsic value set at $176 when you round it up on the left there. And with a margin of safety of 25%, this gives you an acceptable buy price at $132. On the right here, it is actually on the negative side with the bearish price intrinsic value coming in at $95 with a margin of safety. You get an acceptable buy price of $71. If we're going between the two here on the mean, you can see that the intrinsic value is set at 135 and the acceptable buy price is at 101, with the current price as of recording this being at 96.27. This stock does seem to be fairly too undervalued currently. It's something in which I could definitely get into a position of. Furthermore, when you're getting a company with a market cap of nearly, 2.5 trillion, this has actually decreased recently because of the sell-off in their shares, and you're getting this at a PE of 34.5. It just looks to be an amazing price to be buying this stock at, and they are actually projected to grow at 28% over the next year. And with Peter Lynch's valuation coming in at a result of 0.9, we can see that this stock looks fairly valued currently, but again, I would like to bump this up to an undervalued slightly. But based off of discounted free cash flow analysis here, we can see that this stock does actually look to be overvalued based off of its free cash flow growth. So this year, this stock should only be priced in at $24.28. And in the next 3 years, we can expect this to be at $72. But in 9 years' time, this stock should be worth $219. So I think it's fair to say this stock is definitely fairly valued at the moment, if not slightly undervalued. Let's see what the other businesses are saying and if they can compete with this. With the next stock here being AMD. AMD is the scrappy underdog in the world of CPUs and GPUs. They don't quite compete on the same level as Nvidia in the GPU world, but on CPUs they are definitely dominant, with them serving the Ryzen, I believe 3 to 7 or maybe even 9 now chips. These CPUs are basically the brains behind anything computerized, from PlayStations to PCs. They are what makes your computer run, essentially, alongside with the GPU, which is the graphics card, but we're not going to get into all the technicals here. But while Nvidia is dominating the AI world, AMD are not standing still with their new AI chip. The MI300X is their new boldest move yet into the AI and data center market. So what are the key segments for AMD? Well, they have 4 key segments similar to Nvidia, one of these being their Ryzen CPUs, another one being their gaming semi-custom chips, which are ranging from applications from PS5s all the way to Xboxes, so both sides of the battle essentially. Of course, AMD is also within the world of data centers similar to Nvidia, and AMD does actually have embedded Linux products now, which they have acquired through an acquisition, with there being a broad range of applications for these, from automotive to industrial to networking and storage, and many, many more applications, of course, within the world of embedded. So what are AMD actually gunning for? What is their aim at the moment? Well, AMD's big bet is on AI GPUs and server CPUs. They are hoping to grab market share from other leading industry partners such as Intel on the CPU side and Nvidia on the GPU side, of course. With AMD being late to the AI chip party, but they have brought a solid product to their lineup with the MI300X. This has more memory than Nvidia's H100 and is already being tested at places like Microsoft and Meta. But very similar to Nvidia, AMD are not tariff proof. They are obviously going to see the repercussions of this, with AMD also seeing export restrictions on their MI300X chips similar to Nvidia's H100 chips. So what could be the potential response from AMD for this? Well, much like Nvidia, AMD has to make export compliant versions of their chips for China, But of course, the real demand is still for the full power version, so there won't be as much market share in this sector. And Lisa Su, the CEO of AMD, has said that she is working with the US government to get the clearance where possible. So what are the risks for AMD? Well, of course, China is still a huge market for AMD's data centers and gaming chips. If China retaliates or accelerates domestic chip development, AMD could lose sales before they even gain serious AI market share. So how exactly could this all play out? Well, AMD has got a real shot at catching up within the AI market, especially if Nvidia stumbles or if companies want a second supplier, in which a lot of these large companies do, like Meta and Microsoft. But trade wars make their growth run a lot slower, especially when they are still in the investment mode or the R&D mode, of course. Profits are still not massive yet for AMD when you compare it to industry competitors like Nvidia and Intel, but of course the aim is to get to that same level. So now conducting a technical analysis for AMD, essentially advanced money destroyer, as this stock has plummeted in the last couple of years, months, sorry. We can see here that on a retention basis, this stock is actually doing incredibly well, with their mean coming in at 47.2% on a retention. This is of course nowhere near as high as Nvidia's at 55, but it is definitely something in which they can be proud of. Furthermore, on a liquidity basis, they are doing perfectly fine as well, with them coming in at a rating of 1.35. That means for every dollar of debt in which this company owes, they have $1.35 of liquid cash to pay this back in. And on a free cash flow analysis here, we can see that they are relatively volatile, but generally really good. There isn't anything on their quarterly earnings reports in which I can critique. This company is doing really well. And on a 365-day exponential chart here, we can see that they are below the exponential moving average. Furthermore, on a normalized distribution here, we can see that the probability of a positive day is at 48%, the probability of a negative day is at 35%, and a neutral day is at 18%. This is based off of the last year, which of course hasn't been particularly great recently for AMD. So on a probability scale here, I wouldn't actually say this is looking too positive. Similar to Nvidia, they are actually bang on their exponential 91-day moving average, which is positive, and the volume has correlated relatively well with this. Furthermore, AMD's PE is at 84, which is massive. You will have to excuse what has happened here. For some reason, Excel data does not appreciate AMD data. It just really doesn't, so I've had to manually input most of this, which would normally be automated. But looking here on an intrinsic valuation, we can see that AMD looks to be massively overvalued, with an intrinsic value on the left here coming in on the bullish side of 71 and on the right here of 38, with the current price being at 85. This stock does look to be hugely overvalued currently, and that is not accounting for margin of safety of 25%. If we're going between the two of these on the mean here, we get an intrinsic valuation at 54.74 and an acceptable buy price at 41, both of these being massively below where we currently are at $85. And this accounts for essentially this next year's growth, and that is accounted for by the growth rate and the surprise rate supplied by analysts. On a Peter Lynch's valuation here, we can see that AMD looks massively overvalued, with them giving a result of 0.4. And I couldn't actually show you the discounted free cash flow analysis on that sheet because it has broken, but I did copy it over here when I did this analysis this morning, and we can see that a discounted free cash flow yields a result of $296 within 9 years worth of growth. 3 years, this stock should be worth just below $100 at 98, and this year it should only be worth 32. So could Supermicro potentially beat these ratings? Well, bit of a spoiler, I do think they can, but first let's go over a business overview. Okay, so now this is the wild child of the trio. It is Supermicro. They are tiny in comparison to Nvidia or AMD, but they are super exposed to AI, but they are also super exposed to geopolitical tensions. So what does Supermicro actually do? Well, Supermicro isn't just a chip designer, they are basically an AI hardware dealer. They build custom high-performance servers packed with GPUs like Nvidia's H100s. Think of them like a PC builder for hyperscalers, except the PCs are $1 million AI server racks, with their business model being split into data centers, cloud, AI workloads, with most of their growth coming from AI server builds using Nvidia and AMD GPUs. With these being vertically integrated, they control design, assembly, and power efficiency within their products. So why exactly might this company explode in the next coming years? Well, within this recent AI race, Supermicro is essentially a pickaxe vendor. Their revenue and stock price went parabolic in 2024 because every AI firm needs to rely on a company like Supermicro to supply the goods, with them also benefiting from shorter turnaround times than big OEMs like Dell, HP, so startups and hyperscalers go to Supermicro for speed. So what are the current geopolitical problems facing Supermicro and how will this affect the company? Well, for starters, Supermicro's entire product line depends on US chips, especially those from Nvidia, and the Chinese customers are definitely something in which Supermicro definitely depend on. The perfect storm in a trade war currently is obviously something which is going to push this stock down, but despite this, we haven't actually seen this, which we'll get onto in the analysis for this. If Nvidia can't export GPUs to China, Supermicro can't sell servers to them either. They also source components globally, so tariffs or restrictions could definitely hurt their margins. So how exactly have they reacted to this trade war? Well, they have started by diversifying products out of China, including building a large facility within Malaysia. They have also begun expanding US-based manufacturing to meet federal sourcing requirements. But there is, of course, a massive risk surrounding this, with Supermicro riding the AI wave. They are standing on a wire because their success is essentially glued to Nvidia's chain and their Chinese demand. Any hiccup for AMD or Nvidia will signify something bigger onto Supermicro: fewer GPU shipments, export bans, or China retaliation. Supermicro will get hit twice as hard. So how should this all play out for Supermicro? Well, if Nvidia keeps shipping and AI keeps growing, Supermicro could just keep on printing money. But if trade tensions choke GPU supply chains or block exports, revenue could cliff dive, as Supermicro are not diversified enough yet to absorb a full-blown China-US tech trade war. You could essentially see Supermicro as the Ferrari with a super low suspension, one speed bump or one pothole, and it gets very bumpy very fast. And if you think about this speed bump being the decoupling of tech firms between the US and China, that is essentially where we're at. It's going to get very bumpy very fast if something doesn't get resolved. So as I mentioned earlier, Supermicro is nowhere near on the same level as Nvidia and AMD when it comes to their financials. With a current mean surprise rate of 7.4 over the last 5 quarters, this company is obviously doing really well. That is a good retention rate, but it's nowhere near the same level of the competitors mentioned in this video. But on a liquidity ratio, they are actually doing relatively well, with them coming out with a result of a mean of 1.09. However, their free cash flow is definitely not something to brag about. It's very volatile and it is often in the negative, which is something in which you would like to see them definitely improve on. So as far as balance sheet is concerned for Supermicro, it's really nothing to compare to Nvidia or AMD. If anything, especially in the past, they have been known for misguiding their earnings releases and essentially lying. They have now rectified that and fired the people who were basically at fault for this, but it does definitely cast a doubt over their stock, in which has definitely led to a huge sell-off in the past. And right now, looking at a 365-day exponential chart, we can see this sell-off as we are now just above the exponential moving average. We have seen volume correlate relatively well with this, which suggests that it was a justified sell-off. And looking at a normalized distribution for Supermicro, the probability of a positive day is at only 42, whilst the probability of a negative day in the last year has been at 46, suggesting that this stock is definitely in a decline. But don't lose hope all just yet, because I'll get onto why I think this stock is so massively undervalued later on in a few minutes. Looking on a 91-day exponential moving average, we can see that we are now below this as well, suggesting that there could be more selling pressure, or we could definitely expect to meet up with this moving average. Probably not though, especially with the geopolitical tensions currently. So one reason which I absolutely love Supermicro stock is because they have a current PE of only 13. When you compare this to AMD's, for example, which is up in the 80s, this stock definitely looks to be massively undervalued currently. But despite this really low PE, they do actually have a growth rate projected at 41 over the next year, suggesting that this stock is definitely a massive growth stock. And now as to why I think this stock looks undervalued, well, we can see here on a Graham's formula, the bullish side we get an intrinsic valuation set at 177 with the current price being at 29. This stock looks to be a steal on the bullish side with a margin of safety of 25%. This gives you an acceptable buy price at 133, which is over $100 from where we currently are. And on the bearish side, I have an intrinsic value set at 94 and an acceptable buy price at 70. If we go in between the two of these, we get an intrinsic value set at 135 and an acceptable buy price at 101. Furthermore, Peter Lynch's valuation yields a result of 2.9, nearly 3, which means that this stock looks massively undervalued. But when we do move on to a discounted free cash flow analysis, this is where this stock does seem to be a bit volatile, especially because their free cash flow is consistently negative. But I do want to point out down here, previously I did a discounted free cash flow analysis on Supermicro and I had a result of 453. I'll be perfectly realistic with you guys. I haven't got a clue how I came up with that number. It's all the exact same equation. I don't know if I inputted some numbers wrong, but going off of their current free cash flow, they actually are in the negative. So when comparing all of these intrinsic valuation formulas between the three companies here, Nvidia, we can see that about 2 months ago I had this stock valued on the bullish side to be at 246 and now it has actually dropped all the way down to 185 with the recent tariffs in mind. And on the bearish side, this has gone from 129 all the way down to 100. I didn't actually have a discounted free cash flow analysis at that time, but I do now, of course, at 219. However, the actual opposite has happened in the case of AMD. Previously, I had their intrinsic value set at $67 and now this is up at 72. And the bearish side was at 36 and this is now at 38. It's very small improvements, but it is improvements nonetheless. And on a discounted free cash flow, this has gone from 294 to 296. So again, very small improvements. It's baby steps, but it is making improvements for sure. And again, with Supermicro, this has actually increased as well, with it going on the bullish side from 169 to 189, and on the bearish side from 89 to 100. Of course, the discounted free cash flow analysis, I haven't got a clue what happened there, but take that with a pinch of salt. Again, AMD and Supermicro look to be as if their valuation is actually increasing despite this recent trade war, and Nvidia's has definitely shrunk as a result of it. But despite these intrinsic valuations increasing on my breakout indicator here, which gives us a breakout score for current growth, which is of course not going to be good, we can see that AMD and Nvidia are in 97th and 98th, but Supermicro is even lower at 106, with it being way below the other two. We can see that these stocks are definitely getting beaten down quite harshly within the last 20 days, which is just obvious, isn't it? So of course, if you were looking to momentum trade these stocks, it is definitely not a good time for this. It's just a bad time to be momentum trading in general right now. It's just not something that is possible when you're in a decline. But if you are looking for a momentum strategy, then please do hit a like and subscribe, because I will be showcasing which stocks are breaking out when the market does finally recover. And on a 5-day basis, it's pretty much the exact same story, with AMD and Nvidia being right next to each other and Supermicro being right down here as well. So to summarize this video, I think it's fair to say that AMD looks to be overvalued and it's going to struggle quite harshly with these tariffs. Same goes for Nvidia, but they look to be fairly valued currently. But what looks to be massively undervalued intrinsically is definitely Supermicro. But if anyone's going to get hurt by the trade war, it will be Supermicro. But just based off a mechanical strategy here, I've put Nvidia at a buy just because it looks to be fairly too undervalued at the moment. I have put AMD up here all the way at a hold, but realistically I would like to put this stock in at a sell. And Supermicro, despite not having a discounted free cash flow analysis done on it, I have actually put in at a buy because it does look to be undervalued on Graham's formula and Peter Lynch's valuation, but I would like to see them increase on their free cash flow. So I do hope you have enjoyed this video. If you have, please do be sure to hit a like and subscribe. I'm not a financial advisor. None of this was financial advice. It's all just my own opinion, and you should form your own opinion before you invest into the market. I do now actually have a membership subscription on this YouTube channel. I don't really know what that means, to be perfectly honest with you, but if you are enjoying this content and you want to be a member, go for it. I would be greatly appreciated. That doesn't make any sense, but you know what I mean. With that being said, I hope you have enjoyed this video, and I'll see you for the next video. I've just said video way too many times.